The Federal Reserve's accommodative policy continues, and to many that signals the reflation trade remains on. Question, though, how do investors capitalize on that? To answer it, we've got Keith McCullough, founder and CEO of Research Edge, an independent research firm. Keith is currently on the cover of Bloomberg's Markets Magazine, a research renegade, we call you, Keith. Good to have you back.
Good to be
Let
back.
us talk about Fed policy, Treasury policy. We had Neil Ferguson here just a few moments ago, the noted historian, professor of economic history at Harvard, weighing in with much the same viewpoint that you bring to the table, except, incredibly, he's even more bearish on the dollar than the man who coined the term the burning buck. He says the trade-weighted dollar could go down another 10 to 20%. If that happens, what does it mean?
That's a very, very alarming situation if you have that 10 to 20% from here. I'd say lock the barn door, because the American citizenry are going to come after anybody who's in finance. Effectively, you have a massively relevant inflation spike that you're going to see that would be the equivalent of $150 oil that we've seen before, and we saw the afterburn of that. And you're also going to see the afterburn of 0% on American savings rates. And a lot of people in this country do not like that whatsoever.
What about other export-driven companies? Let's just say China and Germany. If this happens, this 10 to 20% drop trade weighted for the dollar, I mean, do they just stoke like crazy their internal growth? I mean, that has to be their goal.
Yeah, it could be, but I don't. You know, we're in uncharted territories on that front. I mean, we're really going down a historical path that we have not seen before. Again, America now is the debtor nation. It used to be Germany, and then it became Japan, and now here we are with the UK. We're the debtor nation. We used to be the creditor nation. So it's a very unique set of players, and a lot of different things can happen that we haven't seen before.
But some people say it's going to still take 10 years to happen, right, for sort of us to change roles. You agree with that?
Right. At 10 years, you know, that would be an accommodative point of view. I think that this thing is in motion.
Let's talk about accommodation as it concerns monetary policy. Tim Geithner, you quoted him last night in a note that you just sent out. Credit is the oxygen. The foundation of the administration's policy seems to be reflate, whether it's to the banks, rebuild capital, get them to lend more to people. Whether that money is actually getting to the people or it's just going straight into the markets is a big question. But let's say that people agree with you, that it's all about reflation. How do you make money as an investor?
Well, if it's all about reflation based on dollar devaluation, that's a story we saw in Germany in the 20s, we saw in Japan in the 90s. It hasn't worked. So it's a doctrine. It's a doctrine of leverage. It's a doctrine of debt. And that's what he subscribes to. I don't think the Australians subscribe to that, the Brazilians or the Chinese. The world is really, moving away from each other on that front. And that's a really unique situation that we haven't seen before.
But does an investor take every dollar of U.S. earnings? Let's say we're here, we're making dollars. Do we take every dollar that we earn and plow it into foreign or assets denominated in foreign dollars? Is that the way to escape this trap?
And or bonds. I mean, if the government is going to issue 0% return on your savings account, you are inspired to save zero. I mean, that's what Japan has learned for the last 20 years. So, Brazilian bonds, Chinese bonds, there are a lot of different rates of return that governments are issuing that are larger than zero.
What about the U.S. Treasury? I mean, 10-year bonds, we've seen some call for the yields to go to 2.5% by this year's end. What do you make of that?
U.S. bonds, I just think, we're going to make a series of higher highs and higher lows in terms of yield, but it's just going to be based on when they finally admit that they need to raise rates. We have a 0% interest rate policy that's based on a quote-unquote emergency. I don't think Goldman's earnings or Google's earnings look like an emergency to me. At the end of the day, this country is moving forward, and the economy is definitely not in a Great Depression.
We heard from the Fed's Donald Cohn just the other day. He seems to be sounding quite a different tone than what we've heard from some of the regional Fed presidents. Goldman Sachs noting early this morning that ought to change your view of what the Fed really might do, because very few of those regional bank presidents vote with the FOMC every time. Do you buy that maybe the Fed is more dovish than comments from the likes of Jeff Lacker might suggest?
Oh, the Fed is absolutely dovish. They are pandering to the politics of the moment. There is no doubt that they will remain where they have remained, which is this extensively easy money policy for, as they say, an exceptionally long period of time.
Gold. $1,000, 50 cents an ounce. Is it still worth investing in?
Yes, definitely. And that's something that I don't think people are bullish enough on. If people aren't bearish enough on the dollar, and I think Neil Ferguson is, they may not be bullish enough on gold. And I think on pullbacks, you keep buying gold, you keep storing it, you keep owning it.
1,300 by the end of March?
That I don't buy into. No, that's a little bit exuberant. But I definitely would be buying gold on all pullbacks.
All right. Keith McCullough, we thank you so much. Keith McCullough, founder and CEO of Research Edge.